Welcome entrepreneurs to another e-learning video class. This is Tony Brancatella, and in this class we look at module 6 of starting a business program, which is the financial plan. So we have looked already at the cost to acquire a customer, and in this video we will look at many things. We'll look at the cash flow, which can be considered to be also a cash budget, income statement, balance sheet. We will look also at ratio analysis, and we'll get to that and explain exactly what that is. And I'll give you a lot more information about if you really want to start your business here in Quebec, what you need to know, such as return on investments. It would also have to do with interest rates and policies and things like that. First things first, let's take a look at cash flow. What is cash flow? Cash flow is the money that is moving, which is flowing in and out of your business on a monthly basis. Simply as that. Money comes in, money swirls around in your business over here, paying wages and stuff like that, and then after it goes out and with expenses and to pay your expenses and bills. So that's basically what it is. Cash in, cash out, cash on hand. So as long as there's cash here, there's a flow of cash, the business still runs. So cash flow is when money is transacted by you right at the beginning or the customer. You start spending money as soon as a customer places an order, staff to run the business, salaries, commissions, the store costs, utilities, rent, also inventory costs. You can't stay in business without a healthy cash flow. And one company that knows that very well is what you see on your screen right now. So a lot of companies survive on cash flow, and how you handle cash flow allows you to grow, all the while making a big profit as some companies are operating today. In some other companies like Amazon, they don't make a big profit but still can operate. So cash flow measures the sources of a company's cash. Uses the cash over a specific time period, usually a monthly period. So in a cash flow statement, we have certain activities. The first one is operating activities. Then you have investing activities. And finally, you have financing activities. So let's look at operating activities. What is cash from operating activities? Well, it refers to the net cash inflow you reported in the first section of your statement of your cash flow statement. So cash from operating activities really focuses on the cash inflows and outflows from a company's main business activity of buying and selling merchandise and providing services also. So all that has to do with operations is part of the operating activities. So cash from operating activities excludes the amount spent on capital expenditures such as new equipment, new facilities, and the cash used for other, let's say, long-term investments. So cash from operating activities also excludes the amount paid to stockholders, I should say, such as dividends. This is not part of operating activities. The second list of activities focuses on investments. It contains a sum total of the changes that a company experienced during, let's say, a reporting period, investment gains or losses. So items that may be included in the investment activities will be fixed assets, such as the store itself being a fixed asset. It also would include lending of money, negative cash flow, or collection of loans if you're doing that in your business. Also, that's a positive cash flow. So this would all be about investing in the business itself. The store itself is an investment that you make. So the last section of activities has got to do with financing your business. So the financing activity focuses on how a company, a firm, raises money, raises capital, and pays it back to investors through the market itself. So it shows the cash inflows and outflows related to transactions with the providers of finance, the example, the owner and the owners, I should say, and the creditors of the actual company. Thus, cash flows from financing activities includes such as proceeds from borrowings, short-term and long-term. Here it also includes dividends. So a sum of money paid regularly by a company to its shareholders out of its own profits are dividends. So cash flow from financing activities shows the investors the company's financial strength. This really tells a story here. So a company that frequently turns to new debt or cash could have problems to grow and be stable. Here's an example of a cash flow budget. You'll notice that the cash balance of the month becomes the beginning cash balance of the following month. Here is your cash sales, and here are your expected cash payments or expenses. You'll see also attached with this video in Google Classroom, I have attached a spreadsheet. I want you to take a look at this spreadsheet, and you'll see that there's a lot of information there that can help you do all your finances for your business plan. What I'm really looking for is not your cash flow. Your cash flow in this spreadsheet will be automatically calculated for you, such as all your expenses here, as you can see. But you will have to calculate your income statement. So the income statement measures a company's financial performance, such as revenues, expenses, profits, or losses. So revenues are your sales of your period of that month. So all your sales that you have calculated will go into revenue. Then you have operating expenses. Expenses are all costs of your business. So you can have fixed costs, which are the same whether the operation is closed or running at 100%. Fixed costs includes items such as the rent of the building. These generally have to be paid regardless of what state your business is in. They don't change. What do change are variable costs. And variable costs include cell phones, computer supplies, credit card processing, electricity, payroll, uniforms, and also office products. And the last part, the income statement, will provide the revenues followed by the expense, and the difference of which will be the gross profit, which will show up on your income statement. The income statement is a snapshot of your company's day-to-day business. Investors look to this to see if your company is healthy or not. Now, for your business plan, as I mentioned, I have attached a spreadsheet. And on this spreadsheet, you'll notice that it will have a few tabs down here: cash flow, income statement, balance sheet, and also charts. So cash flow, like I mentioned earlier, is automatically done for you. Your first step of your business plan finances will be here on the income statement. So you'll have to calculate your expenses and your sales. Now, you'll also notice that there's a lot of yellow on this sheet. So this yellow is to really help you. And the way it helps you is that you do not go into these cells and change those numbers. Those numbers are automatically calculated for you. The only numbers that you should change are here, which is your expenses and sales. You can change your different expenses or add expenses in here. Do not add any columns. Just change. Let's say you don't have any commissions. You can take off commissions and add something else. This is all under the income statement tab. This is the first place you will go to do in this Excel spreadsheet. Again, do not change anything in yellow. Everything will be calculated automatically. You can go look to see for your steps to prepare cash flow, but this is just for information. So these two tabs, you can have more information about the cash flow, but do not go in there and change anything. Your first step would be here in the income statement. The second one here you'll see is the balance sheet. The difference between income statement and balance sheet: the income statement shows how assets and liabilities are used, and a balance sheet shows the company's assets, liabilities, and shareholder equity. Further example, comparison: a balance sheet as of right now, what do you have? How much do you owe? It's a point in time. While an income statement, how much did you make this week, this month? How do they connect? You can see here how cash and accounts receivable connects to the income statement with sales revenue. Costs of goods sold expenses connects with inventory and also accounts payable, and so on and so forth. Net income connects with owner's equity and retained earnings. Now, why is it called a balance sheet? It's called a balance sheet because the assets must perfectly balance with the liabilities. If they do not balance, there is a problem in your spreadsheet. You can see it here. In this example, total assets equals total liabilities. And you can take a look and see exactly what your assets are in cash, for one, inventory, liabilities, accounts payable, wages payable. So these have to match. Now, if you look at your balance sheet, what I've attached in your Excel spreadsheet, there's not much to change here either. So the main focus for you to make your task easier is your income statement. Now your balance sheet, if you want to change your inventory numbers or your equipment numbers, you can. The only thing is, if you look over here, you'll have to, no matter what, have to come up with zeros. This is why it's called a balance sheet. We can discuss more about this individually in mentoring or in class. So it looks like something like this. So beginning balance sheet, where you are, then you have your flow, your income statement, and your cash flow, what happened, and in the end balance sheet, where you are. So this has to match with that. Okay, so now let's look at different aspects of your finances that you could add to your business plan. One of them is break-even point. So what's a break-even point? So break-even point is the amount of sales for the business to begin to break even, the point where total costs and total revenues are equal. Only after you hit the break-even point, your business will start making money, turning a profit. Let's look at an example. John owns a retail store. He must calculate his break-even point of sales for a certain style of t-shirt as follows. He determines the selling price for the item to be $15. He calculates the actual cost to manufacture in Quebec the t-shirt, $9. This means his gross profit on the item is $6. John now calculates his gross profit margin, which is the gross profit divided by the selling price, at 40%. He has calculated his fixed cost to be $4,500. His fixed cost, like we talked about earlier, includes equipment, vehicles, and things like that. So, break-even point in sales at 40% would be $11,250. That would be his breaking point. He also needs to calculate how many t-shirts. Break-even point for t-shirts in total, $11,250 divided by $15 equals $750. So John now knows that he has to sell 750 t-shirts to meet his break-even point. Now, where do you see this on your spreadsheets that I have given you? Well, it shows up in your income statement right at the bottom, break-even point. This is again in yellow, so it is automatically calculated. We'll look now at ratio analysis for your business plan. And again, these are also automatically calculated in the spreadsheet that I have given you or attached in Google Classroom. We will look at current ratio, total debt ratio, and profit margin. Current ratio measures whether or not business has enough resources. So the formula is like this. Current ratio equals current assets over current liabilities. A very simple ratio. So current assets equals cash, current liabilities, all your financial obligations. Here's an example. Current assets, $8,472. Current liabilities, $7,200. Just looking at these two numbers, you have a pretty good understanding if this business is running well or not, or what the current ratio would be. So current ratio would be 8,472 divided by 7,200 equals 1.18 over $1. So for every dollar, you're making $1.18. So would you consider this to be healthy? Depending on the business, certainly. But it is certainly a lot healthier than if it was lower than $1. Next one is total debt ratio. How much is owed or in debt? This is the opposite of the last ratio we just saw, credit ratio. So the formula here is total debt ratio equals total debt over total assets. This is what you owe, debt, not liabilities. Here's an example. Those two numbers there, 22,375 is your assets, 25,000 is your total debt. You can see that the total debt is more than the assets, so you know where we're going with this. Total debt ratio, 25,000 divided by 22,375 equals 1.11:1. So that means $1.11 in debt for every dollar you have. Not a healthy business? I wouldn't think so. You owe more than you have. It certainly is not a healthy business. Again, depending on how your cash flow is coming into your company also. Now, same as the break-even point, ratios are also automatically calculated. You got them here at the bottom of the balance sheet. You have your total debt ratio and you have your current ratio. And then you can see, figure out yourself if these ratios are good as they stand and to time, or are they bad. Again, I reiterate, do not, all values in yellow are automatically calculated. Please do not change any of them. Though, once you have finished calculating your finances, then you can remove the yellow highlighted background to make it look a lot nicer than that ugly yellow color. And the last one is profit margin, the net profit of business sales. And the formula is sales price minus cost equals gross profit. For the profit margin is gross profit over sales price equals your profit margin. Another example, sales price $15, costs $5, gross profit $10. Profit margin 10 over 15 equals 67%. Is this a healthy profit margin? Who's to know? Profit margins vary, but at 67% it would be substantially better than if it was a little lower than that, let's say 10 or 15%. Sounds like the profit margins are pretty good. So the higher the profit margin, better off is the business. So now you want to calculate your selling price from margin. In other words, you're looking for a specific margin in your price in your business. If we have an item that costs $200 and you need 30% profit margin, here is the formula. Selling price equals 200 over the actual 30% equals 200 over 70 equals what you need as a price from 200 is 285.71 to go get 30%. What you will also see in the spreadsheet that I have attached are charts, a lot of charts. This is what I really like to see in your business plan. You can put copies of the Excel spreadsheets once you've taken off the yellow into your appendix at the end in your business plan, I should say. but I really like charts. And you can have charts for many things. You can have charts for sales, you can have charts for closing balance, current ratio, break-even point, so many. And you will find them right there in the Excel spreadsheet. Now let's look at different aspects that you can also include, if you like, into your business plan. Or for your knowledge, if you ever go into business, what you have to look at, that really a lot of companies look at, or investors I should say, when you go into business. One is to forecast your sales. So if you want to forecast your sales for the following year, this is how it's done. So next year's sales equals this year's sales times this year's sales over last year's sales. Now here's an example. Sales this year 8,000, sales last year 6,000. So next year's sales 8,000. 8,000 over 6,000 equals 10,670. So next year's sales for your forecast should be 10,670. Also, what you could add to your business plan, and I will probably have an assignment for you to do along the way, is startup costs. So there's really no general method to estimate your startup costs, or if you have a considerable investment in equipment, if you have a website, a little less. And questions that you have to ask yourself is, do you have enough money to launch the venture depending on what you're going to invest? So you need to determine costs equals all your expenses, and this includes all expenses. You can look at one-time costs, example, business incorporating fees, ongoing or fixed costs, like we mentioned earlier, utilities, inventory, insurance. You can also have other costs, essential or optional costs for your business. So whenever you put your hand in your pocket to spend something or use your credit card, that's a cost. Now there's two essential expense categories. As I mentioned earlier, there was fixed expenses and variable expenses, sales related. Fixed expenses, monthly rent, utilities, administration costs, insurance costs, all of these are fixed expenses. On the other side, variable expenses could be inventory, which will vary, shipping costs, which will also vary, packaging costs, sales commission costs, and direct sales associated costs. All these costs will change and vary. The most effective way to calculate startup costs is to use a worksheet. Now, I will give you a worksheet somewhere along the way in class to work out what they are. That lists the numerous categories of costs, one-time or ongoing, that is needed to estimate prior to starting your business. How much money do you really need? How do you figure that out? Well, number one is be very realistic. You need to have a very manageable amount of money that you can. If it's an amount that you've never had in your life before, it might not be so manageable, especially if you are a sole proprietor. You'll have to look at your credit history, or someone else will look at your credit history for you. So you need to know what that is. And stuff like if you have been or have declared bankruptcy in the past. And what do you have for a loan? Collateral, real estate, cars, equipment, life insurance, partners. What do you have that you can go out and get a loan? Now, don't expect lenders to give you all the money you want based on what you have. So don't expect a lender to accept 100% of an asset as collateral. In most cases, inventory is looked at 50% of its value. Smaller loans may have other options, certainly, such as chattel mortgages. Now, what is a chattel mortgage? A chattel mortgage is a movable article or a business property, may be limited to 80%, like a car, the value of a car, if you are looking for a loan. Now, the lender that secures the loan with a mortgage over the chattel, legal ownership of the chattel is transferred to the lender at the time of purchase, and the mortgage is removed once the loan has been repaid. These are all movable examples. Cars, boats, trailers, electronics, and appliances are all examples of movable property. Another aspect is return on investment. Now, what is the return on investment? I simply put up the information for you to read here. It's the profitability of every enterprise depends on companies' market share. The large companies derive greater benefits from a stronger market position than do smaller companies. Small companies derive small benefits from flexibility. If you want to calculate your return on investment, ROI increases as market share increases. So if you have to calculate your return on investment, the more you invest, of course, the higher the return is. So return on investment equals total investment over sales. Most cases, return on investments, you double your initial investment within 3 years. So this is something you need to know for your business and how much money you're going to invest in it. Okay, so now let's look at Quebec business laws. Property and ownership. All property is either movable or immovable. So movable or immovable, the words state them clearly what they are. Movable means it can be moved, and immovable, it cannot be moved. Now both can be either corporeal or incorporeal. So corporeal property, a car or a house. Incorporeal consists of legal rights to a thing, let's say. So a right is movable if its object is movable, and immovable if its object is immovable. Here's an example. John owns shares in a company. He does not own the assets of the company directly, but his share certificate is a right of participation in the total assets of the company. This share is incorporeal, movable. Another example. John has a right of passage allowing him to cross Ringo's land. John does not own the path, but has a right to use it. His right is incorporeal, immovable. Now, ownership of land, property belongs either to the Crown, the country, municipalities, corporations, or individuals. Now, the owner exercises his or her right of ownership, no matter who they are. By physical acts, he or she occupies the house, builds on it, on his or her land, and cultivates his or her farm. But by legal acts, he or she sells the land, transferred by gift or by will, or leases it. If we look at monetary policy, the practice of a government managing the supply of money to achieve economic objectives. For example, the U.S. uses the Federal Reserve System. Here in Canada, we use the Bank of Canada to either increase or decrease the supply of money, which in turn affects the overall economic environment as a whole. Monetary policy can be referred or is referred to as either being expansionary policy or contractionary policy. This is important stuff to know. So expansionary policy increases the total supply of money in the economy rapidly. Contractionary policy does the opposite. It decreases the total money supply or increases it only slowly. So when you see interest rates being lowered, this is expansionary. Expansionary policy is traditionally used to combat unemployment in a recession. So when interest rates go down, this is considered to be expansionary. On the opposite side, contractionary policy involves raising interest rates to combat inflation. So when you hear about inflation, what's going on is called contractionary policy. Speaking of interest rates, higher interest rates will encourage saving and discourage borrowing. If the demand for borrowing exceeds the willingness to save, the interest rate tends to rise. Companies compare the interest rate charged on borrowed funds with the earnings of investment projects. Let's look at short and long term. So short term, less than 3-month rates on bank deposits, on funds borrowed by the government, on funds borrowed by companies, on funds borrowed by banks. These are considered to be short-term interest rates. Long-term, more than a year, would be the government, treasury bonds, corporate bonds, or mortgages. All this is good to know if you ever go into business. Another thing we need to know is about company concepts, how they run their businesses. And this usually shows up in your business plan. There are 4 of them. There are production concept, product concept, selling concept, and there is marketing concept. Let's see which one you would use. If we look at production concept, it explains how consumers will favor products that are widely available, low in cost. So production-oriented companies concentrate on achieving high production efficiency, making a lot of product, and wide distribution coverage, distributed everywhere. Assumes that demand for a product exceeds supply, and therefore consumers are more interested in obtaining a product than its additional features. So it's production concept. If we look at product concept, this assumes that consumers will favor products that offer the most quality, performance, and features, making good products and improving them over time. They are caught up in a love affair with their products and fail to understand that the market may be moving in a different direction. The product concept leads to a market myopia because they concentrate on the product rather than the need. Myopia means bias. The selling concept assumes that consumers will not buy enough. Therefore, companies must undertake an aggressive selling and promotion effort. Marketing. Consumers show inertia or resistance and have to be coaxed into buying more. Practiced with unsought goods such as insurance, encyclopedias, and funeral plots. Also practiced in the non-profit areas such as fundraisers, college admission offices, and political parties. Selling it. Now let's look at the marketing concept. And marketing concept assumes that the key to achieving organizational goals consists in determining the needs and wants of target markets, delivering the desired satisfactions more effectively and efficiently than competitors. What type of marketing concept are you thinking about right now that I've been preaching from the beginning of the year? Yes, content marketing. So selling focuses on the needs of the seller, marketing on needs of the buyer. The differences between selling and marketing concepts. So the marketing concept is a market-focused, customer-oriented, coordinated marketing effort, aiming at generating customer satisfaction as the key to satisfying organizational goals. So which one do you think I want you to really focus on of all these concepts? Certainly marketing. So there you go, a whole bunch of information for you. I'm quite sure you'll have a lot of questions for me. You can share with me in class, here on Google Classroom, or when we meet in the mentoring sessions. Thank you, and see you in class.